Today I would like to analyze BYD, one of the largest car company in the world. The stock price is down around 37% from the highs in 2025. So we're gonna take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is a market cap of 125.31 billion US dollar. This makes BYD the fourth largest car maker company in the world by the market cap. We also have a dividend yield of around 1.47%, which we can see here had an incredible growth in the last 10 years. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and a declining business. So in 2020, we had a revenue of around 156 billion Chinese yuan. This is a very good growth rate, around 22% from 2019. In 2021, we had a very good growth rate again, around 38%. In 2022, we had an incredible growth, around 96%. In 2023, a very good growth rate again, around 42%. And in 2024, a very good growth rate, around 29%. And in 2025, again, very good growth rate, around 23%. So over the last 5 years, I would say we had a very good growth rate in the revenue. So the check here, and we like to see that. The next thing we're looking for would be the free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. We can see here in 2025 we had a negative free cash flow of around 24 billion Chinese yuan. So that's why we're going to take a look at the operating cash flow instead. So the main difference between the operating cash flow and the free cash flow is the capital expenditures. So we're going to take the operating cash flow minus the capital expenditures, and then we're going to get the free cash flow. So we can see here in 2020, we had an operating cash flow of around 45 billion Chinese yuan. This was an incredible growth rate, around 207% from 2019. In 2021, we had a very good growth rate, around 44%. In 2022, we had an incredible growth rate again, around 115%. In 2023, we had a good growth rate, around 20%. And then in 2024, we had a decline around 21%, and in 2025, a decline around 8%, which would be the main reason for the stock decline as well. And I think the reason for that is that they have more competition, so they need to lower the prices of the cars. So we can take a look here and we can see we also have the capital expenditures increasing many years in a row. And in 2025, it's very high of around 142 billion Chinese yuan, which would be the main reason for the free cash flow decline and also for the negative free cash flow in 2025. So this means the company investing more money into the business, which I think is something positive so they can have more profits in the future. But if we're going to take a look at the growth rate in the last 5 years, I think we had an incredible growth rate in the last 5 years of the operating cash flow. So this would be a check here, and we like to see that. The next thing we're looking for is the free cash flow yield over 4%. This can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we're going to take the free cash flow from 2024 because in 2025 it's negative and it wouldn't make sense to calculate that. So that's around 36 billion Chinese yuan. Then the current market cap is 885.17 billion. And then we're going to get the free cash flow yield for 2024. That's around 4.06%. And I think that's a decent free cash flow yield actually. It's over the 4% that we're looking for. So it would be a check here. But we can also calculate this number for the next coming years. We have here some assumptions for 2026. This could be around 66 billion Chinese yuan. In 2027, around 72 billion Chinese yuan. And I think these numbers could be realistic as well. So let's assume for 2027, the 72 billion Chinese yuan. We're going to divide it with the current market cap, 885.17 billion. And then we're going to get a different free cash flow yield for 2027. The number we're going to get would be around 8.13%, which is a very high free cash flow yield actually. It's over the 4% as well, so the check here. And I think if they can actually reach the free cash flow of 72 billion, this would be a very good undervaluation in my opinion. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can repay the debt with a free cash flow in under 5 years. A very important number, because if a company has too much debt and can repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt. We can see here 66.2 billion. Then we're going to take a look at the short-term debt as well. So we can see here 15 plus a 6.6, so round about 22 billion. Then we're going to divide this number with the free cash flow. So we're going to use that number from 2024, 36 billion. And then we're going to get the ratio that we're looking for. So the number we're going to get would be around 2.45. And I think that's a good number. It would take around 2 years and 6 months to repay the debt with a free cash flow. So that's a good number. It's a check here and we like to see that. We can also take a look at the cash on hand, how much money this company has in the bank. And I think we can see here a very good amount, 175 billion. So that's very good. So overall, I think this company has a good balance sheet at the moment. The next thing we're looking for is the enterprise valuation to free cash ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So first we're going to calculate the enterprise valuation. So that's the current market cap, around 885.17 billion. We're going to add the debt as well. So that's around 88.2 billion minus the cash, 175.25 billion. And then we're going to get the enterprise valuation. So how much the whole company is worth. The number we're going to get would be around 798.12 billion. So now we're going to divide this number with the current free cash flow. So actually the free cash flow from 2024, 36 billion. And then we're going to get the ratio that we're looking for. And that's around 22.17. And I think that's a decent number. It's under the 25 that we're looking for. So the check here. And I think it could be a fair valuation already. We can calculate this number for 2027. With our free cash flow assumptions of 72 billion. Then we're going to get a different number, and the number we're going to get would be around 11.09. And that's a very good number actually. So if they can reach the free cash flow of 72 billion, then we would have a very good ratio. This would be an undervaluation. And it's also a check here. So if they can actually reach this number, I think this company could be undervalued right now. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially if we think the company is undervalued. So we're going to take a look and we can see the shares outstanding actually increased in the last 5 years. So this is also understandable because this company investing more money into the future. So I think they need this money as well. It would not be very smart to buy back their own shares at the moment. So it's not a check here, but I think that's something positive. Can the BYD stock be a good buy right now? The stock price is down around 37% from the highs in 2025. So let's start with a positive about this company. I think they had a great revenue growth in the last 5 years, sometimes even over 100%, and in 2025 around 20%, which is very good. So overall, we like to see that. They also had a great operating cash flow growth in the last 5 years. This is very important as well. And the balance sheet is also looking quite good. So we have a low amount of debt and a good amount of cash on hand. The free cash flow yield around 4.06% in 2024 is also quite decent. And in 2027, our free cash flow assumption, it could be around 8.13%, which is very high and could be already an indication for undervaluation. The enterprise valuation to free cash flow ratio around 22.17 is also a decent valuation for 2024, and in 2027 our free cash flow assumption, it could be around 11.09, which is a very good valuation. We like to see a number under 25. We also have a dividend yield of around 1.47%, which is not very high, but we have a very good dividend growth rate. And overall, I think this company has a very strong positioning. They have a good technology and a very good market position. They're selling a lot of cars in the street market. So overall, I think this company has a lot of potential in the next years. If they can actually reach the free cash flow goals, this company could be very undervalued right now. If you found this video helpful, don't forget to like and comment and subscribe for more content.